Welcome everybody to this to today's CMCC webinar, which is going to run from 12:30 to about 1:20. As you know from the link we sent out, the webinar focuses on the topic of low carbon energy finance, and specifically on the presentation of new research results and their implications for modelers and policymakers. It is my great pleasure today to introduce the two speakers, Dr. Bjarne Steffen, who is a senior researcher with the Energy Politics Group at ETH Zurich. He also leads the group's finance-related research activities. Bjarne is an economist by background. And the second speaker is Professor Tobias Schmidt, who is heading the Energy Politics Group at ETH Zurich. Tobias himself has a double background in the sense that he's a trained engineer and is very focused on public policy and public policy evaluation as well. I have the pleasure of working with these two individuals, which are among the most productive researchers that I've known in my short career, through the InnoPaths project, which is a project in which CMCC is a member. ETH Zurich is a member as well. So today they're going to be presenting you with some results from recent research on the topics of low carbon energy finance. Before we start, I will just take 2 minutes of your time to introduce CMCC. CMCC, the mission of the Fondazione Centro Euro-Mediterraneo sui Cambiamenti Climatici is actually to investigate and model climate systems and its interaction with societies, and to provide rigorous and timely scientific results, which will in turn stimulate sustainable growth, but at the same time protect the environment and develop science-driven adaptation and mitigation policies in the context of a changing climate. The CMCC is spread around Italy. It's got several offices around the country, as you can see on the slide that they're presenting right now. The type of policy, so the research divisions within CMCC are now displayed. And I'm just going to mention that today's seminar has been organized by SEME, the last division that you see on the slide. It's last both in terms of alphabetical order there and also in terms of its being born, because SEME is a very recent division at CMCC. So in terms of other things, so the topics that CMCC works on, we have experience and expertise in modeling, in policy adaptation. We focus on topics of agriculture, society, we predict impacts, but we also have more of a hard science background with hydrogeology, simulations, topics on forest, oceans, and so on and so forth. So in order to get a better understanding of what we do, I really urge you to visit our website where you can find more detailed information. We also do a fair amount of outreach. We have CMCC publications. We organize a wide range of events. We are involved with education, both of the general public, but also of students. And we strive to really engage in communication so that we can really impact both the public and the policy-making process itself. So I think this is it for what I wanted to say in terms of CMCC. At the end of the webinar, you have a question and answer session once the two speakers will finish to talk. And so in order to put forward the question, please take note of the procedure. You have to use the questions menu provided by the GoToWebinar system. What I will do is I will read your question out loud, or at least some of selected questions if there are too many. In any case, I imagine, knowing both Bjarne and Tobias, that they will have their contacts on the slides somewhere. So if by any chance your question does not get addressed, you can feel free to spam them with tons of email related to, nitty-gritty research details. And so this is all for me. You're not going to be seeing me anymore. You're going to hear my voice in the question and answer session. And I'm very, very pleased to give the floor to the two speakers of today, Tobias and Bjarne. Thank you so much for being with us.
Yeah, thanks a lot. Thanks a lot for inviting us. It's really a pleasure to give this CMCC webinar on low carbon energy finance, and we want to really show some research that we've published over the course of this year, and want to discuss what it implies for policymakers and modelers. So before we do this, I quickly want to use one slide to introduce our group. So this is the framework of our group. We're really interested in technological change in the energy sector because we think that's one of the key levers to address climate change. So innovation, diffusion of new energy technologies, and of course finance is really key in that because first of all, finance is necessary for innovation, but of course also for diffusion. And given the nonlinear nature of innovation, it's also important to diffuse technologies and then learn how to improve them further. So diffusion finance, downstream finance is what we're focusing on here and also generally in the group mostly. And of course, we're also interested in how policy can accelerate technological change in the energy sector and can redirect technological change from high to low carbon. So that's pretty standard, but what we're also interested in is the politics behind policy. So what drives a policy change that then results in technological change, and particularly also what happens if we see technological change, for instance, a new clean industry growing, how does that actually affect policy dynamics? So to answer these questions, we have an interdisciplinary team of engineers, economists, and political scientists. So today we're going to talk about finance, of course, and when it comes to finance, I think there's one fundamental difference between high carbon and low carbon technologies in the energy sector, and that is the fact that low carbon technologies are much more capital intensive. This is also what you see on this graph. These are how the levelized cost of electricity are made up for fossil fuel based power generation on the top bar, and then the lower two bars are looking at solar PV and wind, and you can see that these blue stacks are much bigger for the renewable energy technologies, and that's the cost of capital. So in dark blue, cost of equity, and in light blue, the cost of debt. And while we have a very good knowledge by now on these dark gray stacks, the capital expenditures, I would argue that we do not have a lot of knowledge on those blue stacks, and that's actually what motivates a lot of our research. So we really want to get more knowledge into those blue stacks. By the way, we're also working on the light gray part at the moment. What is really important is that if financing is so important, if the cost of capital are so important, then it's really important to get low cost of capital for renewables in order to diffuse them widely. Here is a graph from a paper from a couple of years ago. I took out the axis so you can't see the size of the LCOE because, of course, this is much lower nowadays with costs coming down. But again, this logic of low and high carbon costs can affect the renewable energy share, the renewable energy technologies much more than the fossil fuel-based technologies is pretty obvious here. So for wind and photovoltaics, it's about 40% if you increase the cost of capital by about 5%. Whereas for fossil, that doesn't make such a big difference. So this is kind of the starting point for all of this research that we're going to present. We're going to talk about 4 papers, which, as I said, all came out this year. And here's a summary of the messages that these papers make. So the first one looks at the question, how are renewable energy financed? And what we can see is that renewable energy projects are very differently financed than fossil fuel-based electricity generation technologies or assets, because renewables are primarily financed these days through non-recourse project finance. And why this is the case, you'll hear about also from Bjarne in a minute. The second paper rather talks about the question at which cost are renewable energy financed, and what we see here is that this cost of capital have fallen substantially over the last 15 years, and what we also detect in this paper is a financing experience curve. So that's I think pretty interesting. And the other 2 papers are really taking more of a policy perspective, and they're looking at what's the impact of public banks, for instance, green state investment banks, that's the third paper, or in developing countries, multilateral development banks. And for both banks, we find a very important effect. They can actually crowd in private capital. We observe more crowding in than crowding out, which is the standard argument against these types of banks in the literature. And with this introduction, I'll hand over to Bjarne, who will present the first paper.
Yeah, thank you. Welcome from my side also. As Tobias said, we want to start with the question how renewable energy projects are financed. And how, meaning in this case, which financing structure is being used and why for renewables. A little bit of background. There's two fundamental options for companies that want to finance new projects. The first one is to use corporate finance, basically draw on a company balance sheet which has been financed, and then use existing assets and cash flows to guarantee new debt and finance the new project on the balance sheet of the existing firm. This is the standard way. It's about 90%, a bit more than 90% of global capital markets. So that's the standard. That's also what you will learn a lot about in each Corporate Finance 101. Then there's another option. It's kind of a niche in capital markets, and that's project finance. In project finance, you create a separate legal entity with the sole purpose of realizing a new project. That's why it's also called a special purpose vehicle. So it's a new balance sheet just for the project. And it's also this new balance sheet that you put additional debt, potentially equity on to finance the project. Which means that whoever lends to this project only depends on the project itself, its cash flow, its risk structure, and so on. This is a niche in general finance markets. However, it's used quite a lot in renewables. There's global estimates, about 50% of all investment in renewable energy globally is done in project finance, including countries like Germany, like the UK, like Italy, which are pretty low risk for wind and solar and for investment in general. And for economists like myself, that's a bit of a puzzle because project finance comes with a cost. You have to finance the new entity. You have to finance a lot of due diligences to credibly signal the quality of this individual project to the banks, to the investors. So one would expect that from classical economic theory, mainly for high-risk projects, for projects in developing countries, for projects that have a very unsecure revenue structure, which is not really the case for renewables in developed countries. So we wondered, how much a role does it play, and why is that the case? So that's what the first study is about. The study draws on Germany, using Germany as a case, which is somehow an extreme in terms of risk structure. So it has been rated as the lowest risk environment for renewable energy investments in particular. It's also generally a very stable investment environment, well-developed capital markets. And it's a country which saw a lot of power generation projects being realized across the last decade in many different technologies. That's why we draw on this case. And we create a new data set based on an asset list from the grid regulator and combining that with financial information and with structuring information from trade registers. This data set then allows us to do descriptive analysis, obviously, but also regression analysis to test hypotheses on potential explanations for the patterns we see. Results are summarized on this slide. First, on the left-hand side, which compares the 6 biggest technologies for new power generation projects in Germany. And you see that project finance is massively more used for renewables compared to fossil fuel-based power plants. It's 96% for solar PV utility scale projects. It's about 88% for wind projects. So really the lion's share of these projects needs project finance, draws on project finance, even though these projects, as you see on the very left-hand side, they get a feed-in tariff in Germany. So they are very low risk in terms of the revenue profile, much less risk than the merchant plants below that rely on wholesale electricity prices. Why is that the case? We tested different hypotheses. You see on the right-hand side that 7 motivations in the economic theory literature. Couple are crossed out, especially contamination risk. That's a classical reason. You use project finance because you want to isolate your existing firm from the project grid. That's not the case here. But what we really see as the key driver of project finance is that it's new companies that realize these projects. It's new players. It's often fast-growing renewable energy project developers, companies that act as a sponsor and that grow so rapidly that they don't have a balance sheet at the size needed to handle these projects. So there's no other way for these guys than using project finance. So there's a couple of implications. The first is if renewables and new players rely on project finance, as a policymaker, you might want to create an environment that is conducive to this type of financing. This includes particularly a certainty on the revenue streams as it was provided by the feed-in tariff in Germany. Second, project finance means that banks are important because they assess each and every project in detail and decide whether it gets financed or not. So you want to understand how banks do their job and judge on technologies. And third, it also means that each project has its own cost of capital. So cost of capital are project specific. If you want to study the economic conditions of renewables, you want to understand how cost of capital on a project that develops.
And that brings us to the next paper, where we look exactly at that, the cost of capital of project finance renewable energy assets, again in Germany. As Bjarne just said, nowadays for renewables, it seems like they're not financed through these big balance sheets, but rather on a project by project basis. So we wanted to understand, okay, if that's the case, how has that developed over time? Why do they change? How much do they change? And then also, what's the effect of such change, if there is any change, on their generation cost? So we've seen a lot of learning and cost reductions in the technology costs, so the investment cost, but do we also see some dynamics in the if you remember the graph I showed earlier, the blue part of this LCOE bars? There's some challenges. One, first of all, data is not freely available. So even if you invest and buy your Bloomberg New Energy Finance data set or so, you will not get data on the cost of capital because these project finance deals are typically not disclosed. So the investors have that knowledge, but it's not publicly available. And also for the why part, why did they change? There's quite a lot of drivers that affect interest rates and cost of capital. So what we did in order to tackle this is 4 steps. First of all, we actually used the network of the InnoPath project and talked to over 40 investors who actually have invested in Germany in wind and solar PV, large scale investments, to get actually that data that they have. And they actually gave us this data, this historical data of the deals that they made in the past. And then we can now show the cost of equity, the cost of debt, a debt margin, and also some additional variables like leverage, the loan tenor, so the maturity of the loan, and the debt service coverage ratio, which are all great to understand how banks assess the risks of renewable energy projects. With this data, in addition to this data, we also asked those investors what were the drivers for these observed changes. So we did semi-structured interviews and came up with a framework that you're going to see in a minute. The third step then was to use the quantitative data to run a regression and see whether there is a statistically significant experience curve in the financing sector. And finally, we used those results of the first 3 steps and trying to understand, okay, what's the impact of the dynamics of the cost of capital on the levelized cost of electricity that we have seen historically. So the results of step 1 are shown here. So you can see in blue the cost of equity, in red the cost of debt, and the combined cost of capital with these crosses for solar PV and wind. And you can generally see that there is a downward trend. There's some variance, and typically cost of equity is higher than cost of debt. That's because of the seniority of debt. If we summarize the development, we can say, hey, from the time between 2005 all the way to 2017, we have seen drastic reductions in the cost of capital, 70% so for solar PV, almost 60% for wind. Notice that there was a tax rate change during this time in Germany, so we had to correct for that. That's the gray bar that you see. But generally, there's a major reduction of that. So what were the drivers of these reductions that we observed? essentially there's drivers on 3 levels. This comes from step 2 of our analysis. First one, a general economic level. So this mostly has to do with capital markets and the general interest rates. So what we have seen in this period, and you'll see that in a minute quantitatively, is that we have seen, due to the quantitative easing policy of the European Central Bank, we have seen a massive decline in the general interest rate. So that's a general economic level. This does not have to do anything with renewables as a driver. But then if we focus on the renewable energy sector below, you can see that there's been much more data available, of course, and operational experience of renewable energy assets. The technology itself has improved, and also therefore there were less defaults of projects. We also got much better data on, for instance, wind patterns and so on. And then even one level below, when it really comes to the renewable energy financing industry, there was a lot of learning by doing. So these banks developed in-house renewable energy technology knowledge. They became better at assessing risks. It took them much shorter time to do due diligence of a project than in the beginning. Second, there was an entire ecosystem built around these renewable energy projects. So we had suddenly standardized investment structures that were lacking in the beginning. Partner networks were forming and so on. And at the same time, there was a market entry of more and more investors. The more and more mature renewables became, the more and more interesting they became for more and more mainstream investors. And of course, if you have more capital supply, then you have pressure on the margins. So that's another factor that reduced the cost of capital. So these renewable energy sector and the renewable energy financing industry levels, those really contribute to an experience curve in the sector. So if as we detected these, we said, hey, can we statistically estimate an experience rate? So probably a lot of you have seen technology learning curves. Now what we're doing here is a financing learning curve or experience curve. So again, here you see logged, the debt margin. So that's what a bank earns on top of the general interest rate. And on the x-axis, you see the logged cumulative investments in billions of US dollars. And you can see that there is a statistically significant experience rate with of about 11%. So with every doubling of investment, you can expect the debt margin to go down by about 11%. So that was only, of course, one driver or one effect. The other effect was the general interest rate. So if we compare these two, that's shown on the right-hand side, that you can see the red line representing the experience gained in wind and PV. Then you can see in PV, that has come down from about 2.5% debt margin to around 1%. And wind from about 2.1 to 1.1. So that's interesting. So PV has overtaken wind in terms of the debt margin. But if we then also look at the general interest rate level, you can see that there was also a huge change from 2000 to nowadays. So from about 5.3 percentage points down to 0.3. Now, if we know all of this, we can actually try to estimate what was the impact of these developments of the cost of capital on the levelized cost of electricity. And that's what you see here on this last slide on this paper. On the left, again, PV, on the right, wind onshore. And those stacks which are in the dashed box, they all relate to changes in the financing cost. So this experience effect is in this darker green there with 1% for PV, with 4% for wind onshore. The general interest rate effect is in this light green with 4% for solar PV and 20% for wind onshore. And this yellowish green, that's representing the lower capital expenditures driven by the lower investment cost. So those, if you have lower investment costs, you need to finance less. So in solar PV, this was the dominant driver because the cost of modules just came down so much. Whereas in wind, you can see that actually what we now observe, the general interest rate effects and the experience effects are pretty significant in terms of explaining the changes that we've observed in LCOE. So that's it from that paper. So now we have understood how renewables are typically financed and what are the cost of capital. Now let's switch to the policy side a bit, and let's look at the role of public banks. First, let's focus on OECD countries and look at what could be called green state investment banks. So that's also what we have observed in these interviews. That's what investors have told us. These banks have played an important role, particularly in Germany, KfW, which was involved in the financing of a lot of these projects. So in a paper, we looked at KfW, but we also looked at the UK's Green Investment Bank and Australia's Clean Energy Finance Corporation. Both of these banks, these latter banks, started operation in 2012. KfW is, of course, much older, founded after the war, Second World War, but has long experience also already in renewables. So state investment banks are public banks, and they, all three of these public banks have mandates to support low carbon energy and try to leverage private capital, so attract private capital, which would not flow without the activities of those banks. And KfW, for instance, can do this by, so none of these provides grants typically, or KfW does, but a lot of these, this is just lending. KfW can do subsidized lendings, what's called concessional finance. GIB and CFC can't, so they have to lend at market rates, but still they can spend much more time and money on building up capacity around new technologies, in this case, low carbon energy technologies, and also more time to understand each individual project and due diligence and so on. So what you see here is their investments between 2012 and 2016, and be careful, these three graphs have very different scales on the y-axis. So in Germany, that would be the 100 billion, would be the max in the UK 10, and in Australia 1.8. And you can see they have different foci on in terms of technology. What you can also see for the GIB and the CFC is how much money they were able to leverage. So the light gray stacks are actually private finance, and that's what they were able to leverage. We don't have, unfortunately, these numbers for KfW. So this is, so we were interested, what are their roles? What are they actually doing to leverage this private capital? And to this extent, we looked at these three countries, and we talked to 56 investors, including the SIBs, but also other banks, and particularly a lot of renewable energy and energy efficiency project developers. So these were people who typically were looking for finance because they had developed a project, but and then either used or did not use a loan from these three SIBs. And what we identified is essentially four important roles for state investment banks. And the first one is the classic one that you would expect. That's also just mainstream theory. So they can provide capital when no other people provide capital, and they can also take over de-risking roles, for instance, by providing mezzanine finance or guarantees. So that's the classic one that you would expect. On top of that, they also have a very important educational role. They have in-house expertise, engineers, for instance. Not a lot of banks have engineers. They do, that know how to assess risks, and they also help develop, risk assessment tools and so on. So they're really important in standardizing knowledge and diffusing it throughout the sector. A third role is a signaling role, and that's very interesting because they have such a good reputation, because they have all this in-house expertise. They're often able to crowd in private capital just by flagging that a project is a good project. So we've seen a couple of projects in our sample where investors were trying to seek project developers were trying to seek investments, but nobody wanted to finance their projects. Then state investment banks stepped in and said, hey, we're going to finance parts of that. Who wants to co-finance? And then suddenly all these banks who were not willing in the first place said, yes, we're on. And in some cases, even the SIB didn't have to take or didn't have to provide any loan in the end. And the fourth role is that one of a first or early mover. A lot of investors are afraid of financing a new generation of a technology where there is no track record, where you don't have working hours. But if nobody wants to finance that, the technology cannot gain working hours and experience. So that's kind of a catch-22, and those SIBs can help overcome it by financing the first project so that this technology then gets some working hours and therefore becomes attractive to private investors. So these are these four roles. This was a focus on OECD countries, and Bjarne is now going to take over to talk more about developing country contexts.
Yes, indeed, because we talked a lot about Germany now and the UK and Australia. But if you want to invest in renewable energies in developing countries, you have all the challenges that you have in OECD countries as well, plus a lot of others that you always have when investing in infrastructure in weak institutional environments. So a natural player that is used in many instances that comes to mind in these countries is multilateral development banks. And their role, what type of actions they take, that's the topic of our final paper we'd like to present today. Developing countries are countries and developing emerging countries which in many cases are growing rapidly in their electricity generation capacity. So which type of capacity is built, whether it's low carbon or it's high carbon, that's especially important if you build a lot of capacity and are growing rapidly. So that's why many look at multilateral development banks. These banks also have a long track record in power generation finance and a very ambitious goal for climate finance. If you hear them talking at the UNFCCC COP conferences like each and every year, you notice that, okay, yeah, they're very ambitious. But at the same time, they are also heavily criticized for their fossil fuel business, and there are competing policy areas and interests. And overall, the role of MDB in financing both high carbon and low carbon is not that well understood. This is, in our opinion, mainly an issue of data to date. There is data, but it's either too aggregated. If you look at climate finance reporting, it's very aggregated. Or on the other end of the spectrum, it's very nitty-gritty, detailed on each and every individual project and hardly comparable to get an overall picture. So what we endeavor in this paper is a bottom-up analysis of a lot of projects. So taking this detailed data of 857 projects in total across the last decade, complemented by interviews to cover pretty much every relevant power generation financing by any of those banks that are shown on the picture. So it's both global multilateral development banks like the World Bank Group, World Bank, IFC, MEGA, regional multilateral development banks. You have the African Development Bank, Asian Development Bank, European Investment Bank, European Bank for Reconstruction and Development, and Inter-American Development Bank, and finally so-called South Development Banks. These institutions don't have donor countries in their boards. And the most important ones, it's the Islamic Development Bank that's active across Islamic countries, and CAF, the Development Bank of Latin America. So if you look at power generation finance across all these banks, that's what's shown in this picture in real terms. You notice there's quite significant amount of money that's being invested. Since 2007, it's at least $7 billion per year across these banks. There's a big peak in coal, you notice, in 2009, 2010. This was especially African coal projects at the time. There's another peak in hydro in 2011, 2012. That was huge hydro projects being approved in Asia and Latin America. But overall, over time, you see that if you look at the very bottom line, the share of renewables, excluding hydro, so wind, solar, geothermal, increased and quite significantly from about 10% in the early years to about 50% in recent years. If you split these numbers between the banks, you still see the increase in renewables finance, but to very different extent across banks. This is grouped by different patterns. The first one on the left-hand side, it's the largest pattern, EBRD, EIB, so the European investment banks, the Inter-American Development Bank and the IFC, who basically build a huge renewables portfolio on top of a certain amount of money that they invest in non-renewables, which stays more or less the same. So you have this green bar on top of a more or less same-sized brown bar in the next 5-year period. The second pattern on the top right, that's two banks who actually have a substitution of a fossil fuel-based power generation finance to renewable finance. That's very clear at the African Development Bank. You also see it at the World Bank. Then you have another group which substitutes a little bit of hydro and other renewables. And finally, on the bottom, the Islamic Development Bank, who growth mainly in fossil fuels. So if you then look at which countries these banks are active, you notice that for the Islamic Development Bank in the last 5 years, they did a lot of projects in Africa. This kind of is where the African Development Bank moved out of coal. The Islamic Development Bank seems to have stepped in some cases. So I mentioned before, we also conducted interviews with experts from a lot of these banks to understand why they choose this type of technology or that. And what we noticed in these interviews is there were quite stark differences, surprisingly not so much between banks, but a lot between who we talked to in the banks, and particularly if we talked to the public sector arm or the private sector arm. So on the next slide, this is an illustrative example just for the regional development banks. This splits up the same numbers as shown before, but between the public sector lending, so giving money for energy projects to national governments, and the private sector lending, giving money for energy projects to private companies that realize these projects. And across all these banks, you notice there's way more finance going in non-renewable finance in the public sector, so a much larger share and a much higher share, particularly for the new renewables, so for the green ones in the private sector branches. So it seems there's a difference between these branches in banks which have the same policies for both branches. And the analysis resulted in one key reason, and that's the type of counterparties that exist in these branches. So the parties you have to deal with, the familiarity of the parties with the different technologies. In the public sector branches, where development banks would have to convince a national energy ministry, a national agency, which often has a very established power sector planning, which might have a preference for fossil fuel-based project, which changes much in a slow pace compared to a private sector arena where many new companies emerge, which seems to be quite versatile in bringing forward new projects. So this has a couple of implications. Obviously, there's some countries which only have a public sector or private sector activities in the in the energy sector. So we think it's less about shifting money from public to private, but it's more about if it comes to concessional finance. If it comes to subsidized loan, like from the Green Climate Fund, which is handing out big money for renewable energy projects, one could think about to use that more targeted to nudge, especially the public sector energy activities to move more towards low carbon solution, as compared to the private sector, which seems to be quite vividly moving to renewables in any case. So we're nearing the end. Brief summary of implications across the 4 papers that we presented. Overall, we see that renewables rely on project finance, so banks seem to be a really important actor in financing decisions. Cost of capital are project specific, and project makers may want to understand and may want to influence how banks act in the arena of energy. Second, reductions in cost of capital in the past have shown to be a key driver for lower LCOE of renewables. So that might also be a very interesting policy lever to increase the competitiveness of renewables to try to tackle cost of capital. And one way we saw that works to that purpose is public banks such as state investment banks taking roles way beyond capital provision and in developing country context, multilateral development banks. Finally, we also presented, or Elena actually presented in introduction, some implication for modelers. We think that the key implication for modelers is that for new technologies, capital-intensive technologies, such as many renewables, it's really crucial to use technology and time-specific cost of capital if you want to have any meaningful outcome of cost modeling. And the times of a uniform discount rate, let's say it's just 10% utility cost of capital in all these methods, we think should be over. So much for this tour de force. Who wants to get into all the nitty-gritty research details? They are all in the papers. There's always an option to access them free of charge also if you don't have access to these subscription journals. And finally, 2 more points I want to point out. First, there's also the data that we used available wherever we can do that. We publish the data, so there's the project level data for Germany available. There's the project level data on multilateral development bank analysis available, so you can find that online to use that for further analysis. And we'd also like to thank again our sponsors, the European Union, the Swiss Confederation, and ETH Zurich Foundations. And now, looking forward to your questions.
So thank you, Tobias and Bjarne. I think that was a very rich and dense overview. So I'm actually very pleased to take a few questions which have been asked by the attendees. The first one is a question from a person that joined from Abuja, Nigeria, and I'm going to read the question, which is: the proliferation of low carbon energy in Nigeria and most African countries is lack of financing. How are we able to attract investors here? The cost of capital from domestic banks here is very high and cumbersome to comply with. The multilateral development banks are not doing much either. Climate finance is difficult to access for renewable energy developers. It will be interesting to hear what your recommendations are in addressing these barriers.
That's a very good question, and I'll step in on that. So I've been doing some work with the United Nations Development Program on a project called De-risking of renewable energy investment, and there we have laid out steps how you can make an investment environment attractive for foreign investors, for private sector investors, who are of course pretty risk averse too, but very good policy can help in that regard. And it's important that it's not only one, cornerstone policy, like a good auction scheme or a feed-in tariff or whatever. That's one basis. But on top of that, there's need for what we call policy de-risking. So very good policies that actually reduce risks by reducing the likelihood of something happening to a project. But then also, if that's not enough, adding guarantees and so on, so financial de-risking, which can further bring down the cost of capital. But it's not an easy thing to do. And of course, if you want to change policies, you have to go through the politics, and that's again a bit of a catch-22. Often you have very strong fossil fuel advocacy constituents, especially in Nigeria. I would think. And of course they would block these kind of measures. So in those cases, I think multilateral development banks should step in and help the private sector, particularly, to build those projects, and thereby also create a new advocacy that then can counterbalance the fossil fuel advocacy.
Excellent. We also have another couple of questions, so I'll read perhaps both of them out loud, Tobias, so you have an idea. A question asks, maybe I missed it, but I would have the following question. Did you also look at how technological risk itself influences cost of capital? For example, the risk of technical failure of a wind farm. If so, has this risk changed over time, or put differently, are getting RITs more reliable? Are the RITs getting more reliable, and is it reflected in the cost of capital WACC? I'll also read the second question just in case, you guys. Actually, we have more than one, so let me give them to you, then you can decide how to split the replies. Second question, you mostly look at the PV, wind turbines, etc., and not at the additional transmission line, interconnectors, redispatching and storage, or do you also look at that? What is the difference between these two types of projects? There is also the need to differentiate between investment, pre-development and construction, and operation cost of capital. This is actually a question. We didn't hear anything about this during the presentation itself. I'll let you give with these 3 questions and just let you know that I have a couple of more. So for time.
Okay, so we try to be brief. Yeah, very good question, all of them, I think. Starting with the technology risk and how that changes over time, and do we see that in the cost of capital? So for what we studied in at least the first 3 papers only is asset finance, project finance, asset finance. So this is for technologies which in principle are mature enough and less risky enough, such that financial investors accept this financing structure. So it's not immature technologies, early stage wind or solar and so on, but it's already mature enough such that you can go to a bank and get a 20 million loan on that. Nevertheless, for both wind and solar, which are technologies from the beginning of our period, which have the highest technology readiness levels, we still saw a lot of improvement in technology risk on the nitty-gritty details, if you want. Yeah? This is something like a consolidation of the O&M landscape, for instance. In wind, where in the beginning there was still about 20 manufacturers of wind turbines, and some of them having a better renovation than other, some having a better track record than other. And the industry over the period of our study really consolidating, improving, and now having turbines which have tens of thousands of operating hours experience, and much better understanding of how often they break. So they break less often, and you know better how often they break. And so still this is one of the important drivers that brought down the cost of capital. I think it was also in the framework. Yeah. Maybe very shortly on T&D, and then I leave the final point to you. Transmission and distribution. There's also a big investment need there. We think that there's much less of a dramatic change compared to the generation side. So transmission and distribution always was very capital intense to be invested in, and policy came up with models for that. It's a lot of public finance. It's very strongly regulated private finance and natural monopolies. And now you have some new technologies, but it doesn't change so much in how much money you need or when do you need it or not, compared to the generation side, where you really move from a world where you have some investment in the beginning for the plant, but then a lot of cost in the coal, in the gas, in the oil that you're burning. And now all these fuel costs, they move to the beginning. It's basically redistributed from the entire lifetime or to the beginning of the power plant. And so that's the dramatic change that we see on the generation side. And that's why I think from at least an innovation point of view, this is the more dramatic change and more interesting case for research. And that's where we started our journey there.
On the third question, I'm not 100% sure whether it was referring to the project side, so the project development phase, and compared to the operations phase, or was even referring to an earlier stage, including R&D and so on of these technologies. So I'll answer it all quickly. So on the really upfront finance, R&D and so on, in energy we don't see a lot of venture capital. The private equity that we see is mostly strategic investors who want to get into those new technologies, be it technology firms, be it also big oil companies, for instance. But again, for innovation, also downstream finance matters a lot, because all these learning curves that we observe mean that we have a lot of feedbacks from the field. We can only design a better new generation of a wind turbine because we have good data on the existing fleet, on the existing generation. All this big data can be used then to design a better new generation. When it comes to the project side, and that's a very interesting development that one can see. So the markets has split up a bit. So there's a trend towards investors that develop the project and run maybe the wind farm for half a year or a year or so, and then sell it to an investor who's not willing to take this early phase, because there's still more things that can go wrong. And that's when, you know, very low or very risk-averse investors with very low cost of capital, like, you know, pension funds or insurance companies, can step in and finance this then at a much lower cost of capital. So there has been like a split in these phases of the project.
Okay, so I have to tell you guys, you've raised a lot of interest. There are tons of questions, and I have to apologize to the people whose question I'm not going to read. The speakers will get the questions, and you should feel free to contact them by email. I'm going to just close with, if it's okay, we're 1 minute past due, but I will launch you the last 2 questions of the day, just to leave you hanging, which is, and of course, I'll give you time to reply, but at least if people want to go, they should be free to go. So we have 2 questions. The first one is whether you looked into the role of green venture capital in reducing the cost of capital itself. And the second question is related to the fact that you talked mostly about state development banks, but people would be interested, in your opinion, on differentiated minimum reserve requirements for commercial banks in order to direct investments toward renewables. And they also thank you for an inspiring webinar, which I think is good feedback to get live.
Okay, great.
So I give you guys 2 minutes, and then I'm going to wrap up.
Okay, great. We're also thrilled by all these great questions. So on green venture capital, I'll be short. Again, that's more or less what I said in the previous question. At least when it comes to hardware, there is not that much green venture capital. And when it comes to energy hardware, the problem is that you have very long lead times, very long technology development times, and typically your venture capitalist doesn't have that the patience. Typically, venture capitalists want IPOs within the next 4 or 5 years, and they want, you know, huge potential scalability, huge upsides. And energy hardware, you hardly have that. Where we've seen a more interest again in software solutions for the energy sector. That's where venture capitalists are interested in, and that's an important part of the low carbon transition. That's it on the first question.
Yeah, the other question was on reserve requirements that banks have that might motivate or demotivate investment. There's a debate in the literature. There's also a debate on green monetary policy and green supporting factors, which go in the same direction. Which are all instruments that might encourage more lending in certain asset classes overall, or not. I would agree that has some relevance for renewable energy investments. From a policymaker that wants to specifically incentivize investment in a certain type of technology, like renewable energy or like low carbon technologies, it's a bit of too broad a measure, I would argue, in many cases. There's good reasons for increasing reserve requirements, for instance, or for choosing a certain monetary policy or not, that go way beyond energy policy, but relate to general economic development. And mixing these type of policies with the targeted technology policies, that's a very tricky thing. And I personally fear that instruments like state investment banks or like very targeted renewable energy finance conducive policies is a better way if your specific target is to have more investment, let's say, in wind or solar.
Okay, guys. In the interest of time, I have to cut you short in a certain sense. As I mentioned, you will receive the questions and people can get in touch with you. I have 2 slides still that I would like people to look at. The first one is the forthcoming webinar, which is scheduled for December 12th at 11 Central European time. And it's also on climate services in the finance sector. We'll provide insights for users and providers of climate data and information. You can find the information about the speakers, the discussant, and the moderator online at the CMCC website. And then my final point on the last slide is I would really like to thank you all for attending this webinar, CMCC webinar. You should know that the webinar was recorded. It will be uploaded on the CMCC YouTube channel in the link that you can see over there. You can also find it on the CMCC website. And if you have any further questions about the webinar itself, you can contact the email webinar@cmcc.it. My last words of thanks is for the two speakers. You know, guys, I have great respect for you, and I think you are amazing. Thank you so much for sharing these insights today. I think all of us followed with great interest, and I'm going to formally close this webinar, and thank you again.
Thank you.
Thank you.